Welcome back to the Value Investors Club readings. This is not recommendation, only for educational purposes. All credit goes to the VIC. I'm your host, Timon Wunderlich. Let's start right off with Community Health Systems, Inc., CYH. Let's go to the description. The recommendation was filed on September 4th, 2022 by Crestone, by the user Crestone. Description. Community Health Systems, CYH. CYH represents a highly skewed return opportunity with over 200% upside if the company can handle on a recent spike in labor costs in the next few years before running into funding issues, or 100% downside should they fail at this and slide into bankruptcy with the company's heavy debt burden. There are reasons to believe that the odds of the former are greater than the latter, and hence I find it an attractive option-like investment opportunity. Background. CYH runs the ninth largest hospital system in America, with 83 hospitals, 13,000 beds, and 1,000 outpatient facilities in 16 states, and is the third largest publicly traded hospital company after industry leader HCA Healthcare. Also long, but not the extreme deep value turnaround that CYH is, and Universal Health Services. CYH strategy, like HCA's, is to develop strong local market shares and dense networks in the market it operates, which gives greater negotiating leverage with the primary healthcare payers and thus better returns. In addition, it has focused its footprint in regions in the southeast and southwest with attractive demographic growth characteristics versus the rest of the United States. This approach has delivered reasonably consistent EBITDA margins that have averaged 15% over the past 20 years, about 5 percentage points lower than HCA's, which is a much higher quality company with significantly greater advantages to scale. Consistency in margins for the large public hospital systems is largely structural and driven by paper mix, with over 60% of revenues coming from managed care organizations versus 35% from Medicaid or Medicare. CYH is able to pass on changes in healthcare costs on a frequent basis when its contract renews, or it can seek to negotiate these contracts before renewal when necessary. This only works when the hospital company has sufficient local density to give it leverage with the large managed care players. Current situation. Year to date, CYH stock is down nearly 80%, with the biggest drop off after its Q2 results, when the company missed sales by 6% and EBITDA by 43%, and cut 2022 sales 4%, and EBITDA guidance by 27%, implying EBITDA margins of 10.9% versus 14.4% previously. The primary reason for the disappointment and guidance cut is wage inflation and elevated contract labor costs, which have impacted all the major hospital chains to varying degrees. Typically, contract labor is 2 to 3% of CYH's total labor costs, but in Q1 it reached 13% before falling to 10% in Q2. While a sequential improvement, this was not as much of an improvement as expected. CYH carries a heavy debt burden with leverage of 7.1x net debt to EBITDA. After the Q2 results, credit spreads blew out and the company's senior secured now trades around 10% yield with a B2 rating. With this leverage, if the company is unable to improve its cost situation or it can't raise capital, it could easily default in the next 2 to 3 years. Why I'm optimistic. Despite the massive disappointment in Q2, trends are moving in the right direction. As noted above, contract labor fell from 13% to 10% of total labor costs from Q1. Through the company was Though the company was not expecting an even greater improvement, the company also reported significant improvements in retention rates for its nurses, where turnover has been cut in half since the peak of the end of the last year. Additionally, the company reiterated its view that total labor cost inflation will still be in the 4% range for full year 2022, a moderation from 8.5% last year. Longer term, the company has numerous initiatives to ameliorate its labor situation, including its partnership with Nursing College, which is on track to graduate more than 1,000 nurses per year by 2023. CYS is not alone in reporting improvements in the labor situation. HCA saw improvements in each month of Q2, with contract labor falling 22% from April to June. It also reported improvements in hiring and retention. UHS reported a similar drop in contract labor expense last year and indicated it believes the trend will continue through the end of the year. More broadly, the Kaufman Hall National Hospital Flash Report indicated similar, elevated but slightly improving cost trends. While CYS leverage is high, its debt is convenient light, and its nearest maturity is in 2026. Given its significant breathing room to reduce its elevated costs, pass on the cost it can cut to its primary payers. In addition to cash of 346 million, the company has an untapped ABL facility of 900 million approximately, given it's about 1.2 billion in liquidity. Here's a picture of the debt maturity profile. Okay, I'm not going to read that though. And despite the cut in guidance for the year, the company is still expected to be slightly cash positive. Longer term, the company retains confidence in its targets, which are buoyed by solid demographic trends in its market and sustained expected growth in national healthcare spending. If the company can hit its medium-term goals, it's got way more upside to downside. Next chapter. For the first half of 2022, consensus of 2023 EPS estimates were in the $1.3 to $1.4 range. The stock is now at just 2.67. And for the first quarter, the stock traded from $10 to $14, or 7.4 to 11x 2023 earnings, which seems to be reasonable and undermining valuation of the company. Today, the company trades at less than 0.03x 2023 sales, which are expected to grow almost 5%. 8.3x 2023 EBITDA, and about 17x 2023 EPS estimates, which remain deeply depressed from normal levels at 16 cents. The consensus shows a partial return to normal levels in 2024, when estimates call for a 75-cent in earnings, or a 3.6 x PE multiple. If the company can avoid a highly dilutive capital raise and a debt default in the next couple of years, and the cash flow situation and improving cost situation suggests this is quite possible, there's little reason in my mind that it can rebound to the $10 plus range it traded at the beginning of the year, or at least 275% upside. If the company actually succeeds in hitting its medium-term targets, then it could see over $4 of earnings power by 2026, which at any reasonable multiple would represent a home. Based on the appearance of green shots in cost, hiring, and retention trends, positive cash flow, and adequate time before debt maturities, a backdrop of steady expected growth in revenues and its structural consistency to margins at the company and in the industry, I believe that is more likely than the company survives and rebounds to normal earnings power than that it defaults or is forced to wash out its equity. Hence, I see greater likelihood of the upside scenarios, which easily have more or much more than 200% plus upside, than I do for the downside scenario of total loss to equity. And I find this an attractive, higher risk, but extremely positive scoop bet for my portfolio. I do not hold a position with the issuers such as employment, directorship, or consultancy. I and or others I advise hold a material investment in the issuer's securities. Catalyst, inflation pressure, elevating contract labor as of a percentage of total labor declining continued. Improvement in nursing hiring and retention. Success passing on costs to MCOs. Like I said, this was just a reading. I'm not saying I recommend anything. For me, this is just educational. The recommendation was given by Crestone on the platform VIC. Thank you very much for tuning in. I will upload any new ideas from the VIC soon. So check them out.